This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. I'm Luke Guerrero, and I will be your host over this next hour on this beautiful April 19th, 2024. And as you know, we meet here 5 days a week for one purpose. And that purpose is to leave this hour a more educated and better investor. In order to accomplish that, we typically touch on some educational items and some actionable items, some stories from the news, and we talk about the market. But by far, the most important, and for me, the most enjoyable part of this hour is talking directly to you. Because your finance and investment questions drive the narrative and help make us all better investors. With that being said, we'll talk about the market and we'll talk about those show topics. We have some good ones today, but that comes after we answer our first caller question now.
Hey, Steve and Justin, this is Andrew from Atlanta. I was trying to call about ticker symbol ABG, Asbury Automotive Group Incorporated. I read an article in Morningstar. I'm interested in maybe taking a position with this stock. I'm trying to find a good entry point. If you could please let me know your opinion. I greatly enjoy the show. Thank you.
So ticker ABG is Asbury Automotive Group, and they are a line of franchised retailers, dealerships, sell used cars, and a total care auto segment. So they repair cars. And so as you would expect, if you look at their revenue growth over the past 5 years, 2018, 2019, and 2020 were relatively flat. And then the pandemic hit, supply chains crunched a lot, finding new or even purchasing used cars became more difficult, and their repair segment did pretty well, and their revenue grew pretty exponentially from there, from $7 billion to almost $10 billion in 2021, then up to $15.4 billion in 2022. 2023, it tapered off a little bit, but the revenue is expected to grow again towards the end of this year. So that put them at a 5-year annualized growth rate of about 16%. For this type of company, that's pretty astounding. And so you see their stock price kind of took an upward trajectory from there from 2020, and it performed pretty well relative to the S&P 500. This year, they're down about 4%, and that's because their cash flow and their profitability have really tapered off in the wake of an easing of supply chain conditions. So as you'd expect, their relative strength has taken a dip as well. It kind of peaked in January of 2023, and it's been a little bit of a precipitous downfall since then. Now, over the past month, they were at about 240. Now they're down to about 210. And their debt levels are pretty significant, about $4 to $5 billion now on a $4 billion market cap company. From a relative valuation perspective, not too bad. They're trading at about a 1.3 price to book versus a 5-year average of 2.5. But it's important to note their short interest here is about 10%. And that's because the market, and I tend to agree with them, is pricing in the fact that over the past 3 years, they've had significant growth. And the dynamics and the conditions that have allowed that growth have really alleviated. So for me, I don't think this is a good time to buy into the company. It looks like it's headed down to its support at around 200. And I think it's probably going to dip down beyond that at some point. I think the growth is going to subside a little bit. I think it's going to come back to the reality of where this company should be, which is far less than 15%, 16% year over year growth. Thanks for the call. Now we have a lot of ground to cover over the next 45 minutes or so, and here's some of what we have planned for you, time permitting. Our main focus point concerns this story. Mortgage rates have surged past 7%. Mortgage rates are climbing based on expectations that the Federal Reserve won't cut interest rates anytime soon. So is there a sensible play for wannabe home buyers? We'll talk about mortgage rate increases, interest rates, and the Federal Reserve and how that affects mortgage rates indirectly. We also have a couple more topics that we're going to touch on. One is about the Fed overnight lending window. It is a centuries-old lending facility meant to help banks that are approaching turmoil or in crisis. And the way it's been utilized over the past couple years has shown some of its weaknesses. So the Fed is looking to change the stigma around its utilization and change the preparedness of the banks before they may need to use it. We'll also talk about the Swedish stock market and how it has been successful in raising capital for small and mid-cap companies, how its performance has been particularly good relative to other European countries, and the lessons that the US and Europe can draw from its performance. Should we have some time at the end of the show, we'll also talk about a new report out of the IMF, which has a perilous opinion, if you will, about the Chinese and US debt situation and some of the ramifications for really the globe and all economies if they don't rein in their outsized debt issuances. We also have some voice bank questions ready to play, including one on 401k contributions and one on CTRA, which is Coterra Energy Incorporated. We also have some questions that came in from the comment section of the InvestTalk YouTube channel we'll be getting to. And since it's Friday, I'll share a brief excerpt from the newest KPP Premium newsletter. And of course, most importantly, we welcome your live finance and investment questions now on 888-99-CHART. Now we're going into a short break, and on the other side, we'll talk about today's market activity. Please remember, you can call anytime and leave your questions on the InvestTalk voice bank at 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART. Enjoyed our insights on InvestTalk?
Great news. Our podcast is available on all major platforms.
Make sure to subscribe wherever you listen to your podcasts.
And get the latest in investment advice across Spotify, Apple Podcasts, and more.
Subscribe now and join our community of informed investors.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
Let's talk a little bit about the market today. U.S. equities were mixed overall. The Dow was actually up 56 basis points, while the S&P 500 was down about 90. The NASDAQ significantly worse at about 2%, and the Russell 2000, surprisingly, small caps, up 24 basis points today. And so the S&P 500 and NASDAQ actually marked their sixth straight decline and third straight weekly drop. Pretty significant. The equal weight outperformed by almost 1%, actually over 1%. And that was because there was a sizable drag from big tech, mainly semis. SMCI had a big run up and today was down, I think, over 20%. Outperformers include credit cards, casinos, airliners, the media. Supermicro, actually, there was that sell-off. It was down 23.14%. NVIDIA's shares posted its worst day since March of 2020, down 10%. And so other than the AI drag today, really, there's a big focus on Israel and their response to the Iranian strikes, and that they really just appeared to be pretty limited. And so far, there's been no real calls for retaliation, something that is going to be a benefit to the bulls. Israel's strike last night on Iran is what really was seen as that long-awaited retaliation, but it wasn't as significant as many people thought. So really summing up the week, it was a good week for the bears. There was more cautious market psychology this week following the S&P 500 breaking down below its 5,000 barrier for the first time in quite some time. And the Fed speak continued to be consistent with the higher for longer rate narrative. The week's solid economic data, big retail sales beat, stronger Philadelphia Fed reading, still low jobless claims contributed to a notable bond yield backup. The 2-year came in close to pushing above 5%. And geopolitics was a notable overhang all week, though Israel's response seemed to be more moderate than some people expected. On the bullish side of news, there was deeply oversold conditions heading into the weekend. By Friday, only 28% of the S&P constituents actually remained above the 50-day moving average, down from 84% as recently as the end of March. Rate cuts have been delayed, though not deleted, which is good news, and good economic data is still seen as good for supporting consumer spending, which has been a big part of economic growth, as well as labor market, corporate earnings, which are expected to come in solid as the Q1 reporting season evolves. And this week's $13 billion 20-year Treasury auction was pretty well received. So overall, it was a mixed week. The market obviously down, but there's still some positivity coming today. Now let's head over some numbers because on Friday we generally make time to fit in a quick rundown of key benchmark numbers. So let me hit you with those now. The 2-year Treasury yield was at 4.975%. For perspective, last week it was 4.894. 9 weeks ago it was at 4.66. 108 weeks ago it was at 1.961. The 10-year yield was at 4.615 today. Last week it was at 4.518. 10 weeks ago it was at 4.17%. And 84 weeks ago it was at 2.83. Gold was priced at $2,395 per ounce. Last week it was at $2,344. 5 weeks ago it was at $2,156. 23 weeks back it was at $1,935. And 93 weeks ago it was at $1,809. Silver today was at $28.76 per ounce. Last week it was at $27.94. 5 weeks back it was at $25.18. And 89 weeks ago it was at $18.64. Oil was selling for $83.10 a barrel today. Last week it was at $85.66. 2 weeks ago it was at $87.25. 10 weeks ago it was at $78.04. 27 weeks ago at $87.44, and 119 weeks ago is at $66.62. The national average for a gallon of gasoline, regular gasoline, is $3.67 per gallon. Last week it was at $3.63. 10 weeks back, it was at $3.10, and 114 weeks ago it was at $3.57. In my state of California, it was averaging $5.45 per gallon. 5 weeks ago, it was $4.88. 25 weeks ago, $5.32. And 101 weeks ago, it was $5.87. For comparison, in Vermont, today gas was averaging $3.56 per gallon. That is $1.89 less per gallon than gas in California. Now let's keep things moving and pivot back to the InvestTalk voice bank. You know the number, 888-99-CHART.
I have a quick question. I am 26 and I'm wondering how much I should be contributing to my 401k. I make $80,000 a year and I can contribute up to $20,000 a year and my employer matches 6%, but I'm not sure if that's like way too much, the $20,000 to contribute versus having that in other brokerage accounts. Thanks so much. Bye.
Yeah, so I think like a lot of questions, where you want to contribute and how much you want to contribute is very case dependent. So a lot of people can't afford to contribute as much as they would like to because they have debt or they have bills or maybe they're planning a big purchase. But I think the best advice I can give is first and foremost, contribute as much as you can. But always try to, before you contribute to other types of accounts, get to that matching maximum with your employer. Why is that? Well, if they're matching, they're giving you dollars. They're giving you free money. So that's the biggest benefit of employer-sponsored 401k plans. Now, you can make an argument that beyond the employer sponsorship match, maybe you want to look to give it to a different type of investment account, be it an IRA or a Roth IRA, or even a taxable brokerage account. The question a couple weeks ago came to me saying, I don't contribute to my 401k because I want to start a business later. And the advice I gave that caller was, that's fine. Because one of the things people don't think about with retirement accounts is that the money's locked up. There is also an opportunity cost to that. So I think if you are saving for different purposes, that's why you might save in different accounts. But with your 401k, if you're able to, you always want to hit that match maximum so you're not giving up those free dollars from your employer. Thanks for the call. Now it's Friday, which means the weekend is almost here. But before we head off to the weekend, we still have some work to do and some stories to come. This is InvestTalk, now with more than 58 million downloads. We're going to head into a short break, so we hope to hear from you at our line, 888-99-CHART.
You are invited to be part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success.
Now, my main focus point today concerns this story. Mortgage rates have surged past 7%. Mortgage rates are climbing based on expectations that the Federal Reserve won't cut interest rates anytime soon. So is there a sensible play for wannabe home buyers? And in order to talk about this story, about mortgage rate increases, it's important to talk about interest rates and really the Federal Reserve. And so, as we mentioned, mortgage rates have just soared past the critical 7% threshold. And what does that really mean for buying, selling, or really just keeping an eye on your investment is a complicated question. Because mortgage rates hitting their new peak with the 30-year fixed rate mortgage averaging 7.10% as of the latest data from Freddie Mac, means that they've jumped from where rates were just a week ago at 6.88%. And comparing that to a year ago, the average rate was actually only 6.39%. And crossing that 7% mark is more than just a number. It's, in a way, a psychological barrier that has significant implications for affordability and the broader market, even beyond the housing market. So why the sharp increase? Well, it's largely driven by the expectation that the Federal Reserve won't cut interest rates anytime soon. And not only will they not cut interest rates anytime soon, but the degree to which they're projected to cut this year has fallen as well. And this is a direct result of inflation, which is still a pretty key concern, as it's been staying hotter than many would like, which in turn impacts the Fed's decision. And so with the Fed on hold, it's important to note that people talk about how important interest rates are and the implications they have because the Fed doesn't directly set mortgage rates, right? The Fed sets a target policy rate and all other rates are associated and affected by that. So how has this really changed the dynamics of the housing market? Well, we saw it last week. U.S. home sales took a notable dip in March. And the mortgage rate isn't really the only problem within the housing market. High property prices are at issue. Low inventory is an issue. Low inventory also being affected by interest rates because if people can't use debt to home builders, can't use debt as much, it's more costly. It means they can't build more homes. So that affects low inventory as well. And as a result, the median price of an existing home is now up to a staggering $393,500 last month. How much is that compared to last year? That's 4.8% higher. Now, we also have to add on top of that, there's some legal complexities as well. We mentioned about a month or so ago that there's a big legal settlement on the horizon with the National Association of Realtors. And that could change not just the cost of homes, but really how buyers and sellers interact within the real estate market at all. Are they going to use real estate agents? What does that mean for buyers? What does that mean for buyer protection? Does that mean that people who have the ability to pay real estate agents up front are going to be able to better pursue homes? There's a lot of complexity there. And even though it's yet to be approved by the court, it's already influencing how people approach buying and selling these homes. So if you're in the market to buy a home, it's important that you keep a close eye on both mortgage rates and the broader economic indicators. And if you're selling, consider your timing and how these rates might affect potential buyers. Because like I said, it's a complex time, but knowledge is power. Stay informed, and you'll be able to navigate really one of the most important financial decisions of most people's lives with confidence. Now, I hope you've been telling your friends and your family that our InvestTalk audio podcast is also posted in a video form now on our YouTube channel. It seems that every day now we receive finance and investment questions from the comment section of our InvestTalk YouTube channel. So here's one that came in recently about USFD. I've been looking into USFD, which is US Foods. Just curious what you guys think of the company and if it would be a good long-term hold. So the ticker USFD, US Food Holding Corp, is a food servicing distributor, and they primarily sell frozen and dry food and non-food products to food service customers. They're a wholesale food company. And it's a $12 billion market cap company that pays no dividend and has about $5 billion in debt, pretty modest debt levels. And because of that, its times interest earned, its interest coverage ratio is about 3.41, which means they're not highly leveraged. Over the past 2 years, their cash flow has been improving, their profitability has been improving, and they've been pretty strong, especially since October when they've been on a consistent uptrend until they tapered off a little bit towards the beginning of this month. Now, if you look at its price performance versus the S&P 500 over the past 5 years, it's actually underperformed by about 5%. But in terms of its peers, its industry, it's actually outperformed its industry by about 4%. And its relative valuation sits at about 2.8 on price to book and about 15 on price to earnings. So pretty modest. And it's had consistent growth ever since 2020. It's been growing consistently over the past 3-4 years. And over the past 5 years, it's had a consistent growth rate of about 8%. The company seems to be pretty fundamentally strong. Its relative strength is still high. Its debt levels are modest. It's set to earn more this year and next year with improving margins. Overall, I think it's a pretty good company, and it's really shown out in terms of its price performance relative to its industry. So if you're looking for a company within the food wholesale space, I think this is a good one to go with for a long-term hold. Now, on the next Invest Talk, we'll look into the story behind this question. What has stalled this year's market rally? All three major U.S. indices are on track for their first negative month since October 2023. That's Monday, but for now, I'm Luke Guerrero, and I'm ready to take your calls at 888-99-CHART.
Hey InvestTalk community, Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast.
Hi, Duncan from New York. Thank you for all that you do. I just have a question on two stocks. My thesis for a long-term play, as climate change starts getting a little worse and worse, there's obviously going to be a lot of, I would say, hotter days these days. And I'm looking into air conditioning stocks or air conditioning distributors. The two stock tickers that I have is LII, Lennox Company, and AAON, AAON. I know Lennox is a huge company. I think on some website that like the return on equity is up like 100 or something like that. And AAON, its return on equity is about like 15, but it's a much smaller play, like I think a small cap company. So just wanted to know your 2 cents and fundamental analysis, and I really appreciate everything. Thank you and have a good day. Bye.
So the two companies at question, and I do like the thesis, let's start out there, is Lennox, and AAON are the tickers. And so looking at those two companies, Lennox is a $16 billion company, so, on the larger end of the mid-cap space, and AAON's a mid-cap company as well, about $7 billion. Looking at their margins first and foremost, I think I give a point to AAON. Their net margin is 15% relative to the sector average of about 10%, whereas Lennox is only 11%. And that margin is actually supposed to improve next year for both of those companies, so that's kind of a wash there. Taking a look at how they're capitalized, it looks like the debt levels for AAON are significantly smaller, $62 million in debt on a $7 billion market cap company versus $1.5 billion in debt on a $17 billion market cap company for Lennox, but really minimal debt from that perspective there. Now on valuation, because remember we talk about this all the time, it's not just about buying good companies, it's about buying good companies at fair prices. It looks to me like Lennox is a little bit more fairly valued on price to earnings at 23, whereas AAON is more fairly valued on price to book at about 9. And looking at both of these relative to how the sector is doing, I would say that AAON is actually more fairly valued because that price to book is closer to their competitor average. I really like the thesis on both of these. Like I said, I think that these are both good investments. Over the past 5 years, AAON's performance has been significantly better, frankly. And just given that they have really no debt at all, they have more room to capitalize with debt if they wanted to. Their margins are better, and I think it's a lower valuation. If you had to pick these between these two, I would definitely go with AAON. Thanks for the call. Now, the KPP Premium newsletter was finished today, and it will be distributed to subscribers tomorrow morning. But we have a preview for you. In the market conditions section, we explained that the S&P 500 closed down for the 6th straight day as technology stocks continued their struggles this earnings season. The Dow Jones Industrial Average gained 212 points, or 60 basis points. The S&P 500 fell 90 basis points, and the NASDAQ Composite dropped 2.1%. The S&P and NASDAQ have closed down all 5 days this week. It's the first week the S&P 500 has closed lower all 5 days since February 28th, 2020, according to the Dow Jones market data. There's a broader market trend where investors are reallocating from growth-oriented tech stocks to more traditionally stable sectors in response to ongoing market volatility and shifting economic forecasts. The banking sector has shown resilience amid wider market turmoil, while the industry insiders have stressed the sector's ability to manage exposure to the volatile office property market. Major banks have maintained robust loan loss reserves, with a median reserve ratio for office loans at 8%, consistent with previous quarters. On the global stage, oil markets displayed initial volatility following the rising geopolitical tensions in the Middle East, but quickly stabilized. There's a lot more commentary detail in the newsletter, as well as a stock ideas section, where we highlighted a company that operates in the financial services sector and offers brokerage, banking, and wealth management services. With a strong market position and robust financial performance, it has shown resilience in volatile markets. Keep this company on your watch list, and if strength holds, it could be a great addition to a portfolio needing exposure to financials. Also, we looked at a diversified aerospace and defense industrial company, which was formed by a merger. The company operates in 3 segments: as a diversified aerospace supplier, an aircraft engine manufacturer, and a defense prime contractor. This company can make a good defensive position for most portfolios. If it grows earnings the way it is projecting, we could see this stock outperform. We name names in the newsletter, and subscribers receive the full edition via email each Saturday, so subscribe anytime at investtalk.com. Now let's shift gears and talk about a century-old tool from when the Fed was founded that is supposed to help stabilize the financial system. And so let's recall the collapse of Silicon Valley Bank last year. This event triggered a significant reevaluation of the Federal Reserve's discount window, which is a mechanism, like I said, that dates back to the Fed's inception in 1913. And what does that all mean? Well, when Silicon Valley Bank collapsed, it kind of highlighted a glaring issue, and that's that the bank wasn't even ready to utilize the Fed's emergency lending facility, known as the discount window, which could have potentially slowed its downfall. And this unpreparedness was due in part to the stigma associated with even using the window, as it often signals a bank's financial weakness. Now, regulators are rethinking this strategy. They believe that mandating that banks be better prepared to manage a collapse more orderly and being able to better control a bank's failure means it'll be less disruptive to the market, but also to its customers. So what are these proposed changes? Well, they're new rules that would compel banks to have far more collateral pre-positioned at the discount window, making it easier for them to utilize when they need. It also means they'd be in a better position to borrow substantial sums relative to their uninsured deposits in case of an emergency. Another rule change would be a testing requirement, which would require banks to routinely test their ability to draw from the discount window. Another change would be an improvement to the window itself, because we recognize that the discount window is crucial during financial stress. They want to enhance its efficiency, enhance its ease of use. If your bank is failing, it shouldn't be difficult to get the much needed relief, should it? Up until last year, banks had to initiate access, get this, via a phone call. but there are plans to automate and improve the technology used to access it. The most important part, in my opinion, is the stigma and transparency. Currently, the names of borrowers are kept confidential for 2 years to help manage this issue, because if the market sees that a bank is approaching the window, then it can really exacerbate a run on the bank, right? If nobody takes their money out, the bank is solvent. If everybody starts to do the rational thing, which is take their money out at once, the bank becomes insolvent. That's where the problem is. The difficulty there is maintaining confidentiality while also ensuring transparency in the Fed's balance sheet report. Now, it's important to keep in mind that these regulatory changes are not just about preventing another bank collapse. They're about strengthening the entire banking system by making it quicker and easier for banks to respond to crisis without panic or severe disruption. So it'll be interesting to see how those changes affect really the overall health of the financial system. Now let's go ahead and play another InvestTalk caller question that came from a listener in Germany.
Hello, Stephen, Justin. This is Paulo from Germany. I'm a loyal listener to your show. Today I have a question about Coterra Energy, and I would like to have your opinion if it's a buy, hold, or sell at this price level, because I'm already invested in Coterra and I actually want to increase my position because I actually think they are a little bit underperforming the sector, and maybe it's a good time to buy in a little bit more. Okay, thank you. Bye-bye.
Well, thank you for your loyalty, and we're happy to answer your question. And that question is about Coterra, ticker CTRA, and it's a diversified energy company. So it explores, develops, and produces oil and natural gas from its many properties. And so the first thing that I like about this company is 100% of its revenue comes from the US, which means there's not a lot of risk in a time of rising geopolitical tensions from issues with foreign countries, right? And most of its revenue comes from oil, about 45%, 39% from natural gas. So those are the two predominant commodities that are going to affect the revenue streams of this company. Now, it's a pretty large company, $20 billion in market cap, and it's got very minimal debt, $2.5 billion. Its cash flow is improving. It's actually been pretty good since 2021 as its profitability, but it's tapered off as the natural gas space has over the past year or so. And because of that, its relative strength is at about 80 right now, after being significantly higher at the beginning of the year. And the caller mentioned it, and he was correct, that it has underperformed the energy market, or the energy sector rather. And a lot of that is probably due to its exposure to natural gas. But looking at its relative valuation, it's trading at about 1.6 price to book right now, well below its 5-year average, probably due to how natural gas has been performing. And its forward-looking PDE is only at a 12.4. So if you're looking to get into the energy space, a company that has a 5-year annualized growth rate of about 20%, if you take out those outliers, it's probably closer to 12%. That's still pretty good. And at a time when energy, people are rotating into sectors that historically do well when value does well, like energy, I have no issue with you adding more to Coterra, especially considering what its relative valuation's at. It doesn't seem overvalued. Seems like a good play to me. Thanks for the call, and thank you for listening all the way from Germany. Well, 2024 is moving fast, and we are into the second quarter. You may have noticed that we've been telling you for a while that a new market environment has taken hold. So let me remind you that here on InvestTalk and at KPP Financial, we operate with a philosophy of independent thinking, shared success, where we offer unbiased guidance, practice parallel investing, where we invest alongside our clients with investment strategies that we implement for ourselves. So I encourage you all to take advantage of our offer to provide a free portfolio review assessment via telephone, Skype, or GoToMeeting. Send us a message through investtalk.com, and we'll set up some time to go over your portfolio.
Hi, Justin and Luke. Good evening. This is Said from Charlotte, North Carolina. I have a question about the ticker symbol HCA, Henry Charlie Alpha, HCA Healthcare. Currently, it is at 300 plus change. I do not have this in my portfolio, but I would like to see if the fundamentals are strong and what's your take on this one. I'll listen to you on the live. So thank you so much. Have a great weekend. Bye-bye.
So the question is about HCA, which is HCA Healthcare, and it's a leading hospital chain with facilities across much of the United States. And so, the strength of its business, I think it has a pretty significant economic moat. It's kind of difficult for people to get into this type of space, which is certainly something that is good for this company. Now, year to date, they are up 12%. And over the past 5 years, they've outperformed the industry by 8.4% on an annualized basis, as well as the S&P 500 by 3.1%. Pretty significant. Now, taking a look at its financial health, really the balance sheet, its debt levels for a $78 billion market cap company, it has $41 billion in debt. Pretty modest, considering that it earns enough to pay its interest almost 5 times over. And so their cash flow has been steadily increasing, though not by much. There were some waves during the pandemic, understandably, and its profitability has been pretty stable as well. And really, that all goes to the fact that their relative strength has also been stable over the past year, as they've been buying back shares since 2021, and their earnings look like they've been upgraded pretty significantly over the past couple months. So earnings per share, they made $18.96 in 2023. They're projected to make $20 this year and $23 next year. Looking at the relative valuation, modest, 14 times price to earning. That's pretty good. I think that their revenue growth has been pretty stable, even with the pandemic helping them out a lot. I think, like I said, they have a pretty significant economic moat. They have a history of outperforming. They don't really pay that high of a dividend, but it's been consistent from about, 80 basis points to 1.2%. I think it's a great name. I think that this is a good company to get into. I have no problems with it at all whatsoever. Thanks for the call. Let's go ahead and answer another InvestTalk YouTube channel question. This one says, a few months ago, you discussed India and Mexico as being markets to keep an eye on to potentially diversify a U.S. heavy portfolio. Are FLMX or FLIN good funds to achieve exposure in these markets? Thinking about making each of these ETFs 1.5% of a taxable position with a 10-year time horizon. I have a mid to high risk tolerance. Well, FLIN is a good fund. We know that because we actually talked about that one last week. It's the Franklin FTSE India ETF, and it is relatively inexpensive and gives you good large and mid cap exposure. So let's focus on FLMX, which is the Franklin FTSE Mexico ETF. And so looking at this briefly, because I imagine it gives you the same type of large and mid cap exposure, but to Mexico. And it does, 51% in large caps, 29% in mid caps, and some small caps as well. Now, as we're heading into a break, we will talk a little bit about this and what my opinion is on how much exposure you should get to these types of funds if you believe that these countries, these markets, are going to do better. This is InvestTalk. I'm Lou Guerrero, and we have one goal here, and that's to help you achieve your financial freedom. And our work continues after this break. So get your questions in before we head off for the weekend. 888-99-CHART.
Everybody wants a secure financial future, but getting there takes strategy, discipline, and the right information. Welcome to the InvestTalk podcast.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
Now, before we headed to a break, we were answering a YouTube question that came in about if FLMX and FLIN are good ETFs if you think that India and Mexico are going to do well. And FLIN and FLMX are both, like I said, Franklin funds that have good mid-cap and large-cap exposure in their respective countries. And they're also both pretty cheap. I believe FLIN is around 15 to 20 basis points, and FLMX is 19 basis points as well. And similar to the question that came in before a week or so ago, I think FLIN, FLMX, good funds. They give you broad, diverse, large and mid-cap exposure, probably capping given some RIC restrictions within these types of funds, but overall they give you good exposure to the market. Now, the second part of this question, which I think is the most important, is the 1.5% weighting in your portfolio. And so if I'm thinking about how I want to weight a fund, right? Or how I want to weight a name. If you think that India and Mexico are going to outperform, then in my opinion, you should probably weight them in a higher proportion than the total market, okay? The total market is your starting point. So how much of the global stock market is India? Well, it's 1.5%. Mexico is less than that. So if you think in your global fund that Mexico and India are going to do better, then you should probably weight them higher than what the standard allocation is. So I don't have a problem with you going above 1.5%. Don't go crazy here, but certainly I think these are two good funds if you want to get this type of exposure. And I just wanted to reframe your mind a little bit and how you might want to construct a portfolio if you're trying to make active investments based upon your opinion of what markets are going to do better. Thanks for watching. Now, before we head off for the weekend, I want to shift gears over across the pond and talk about Sweden. And Sweden's NASDAQ Stockholm has really been a beacon for small and mid-sized enterprises that are looking to go public. And that's really in stark contrast to what you've seen in the UK and other European nations. And that's because over the past decade, Sweden has seen 501 companies list on its stock exchanges. For context, that's more than France, Germany, the Netherlands, and Spain put together. So what makes Sweden so attractive for these IPOs? Well, it's the ecosystem that supports the listing. One of the key elements that drives Sweden's success is really its investment culture. Nearly every segment of Swedish society is engaged in the equity markets, from everyday retail investors, private banking clients, institutional investors. All of them focus on small and mid-cap companies in one way or another. And so this broad-based participation is supported by policies that promote financial literacy and market engagement. For example, in 1984, Sweden introduced Allmanspar, which I probably mispronounced, which was a program that opened the doors for ordinary Swedes to invest in the stock market. How did that work? Well, by the 90s, millions of these accounts were active, which set the stage for launching these small and mid-cap funds that gave investors exposure. In 2012, Sweden introduced investment savings accounts called ISKs. Those simplified by removing the need to report holdings or pay taxes on capital gains and dividends, instead taxing based on their total value, further encouraging participation in the markets. In that time, its main stock index surged 85% over the decade, significantly outperforming major European indices. So this success story really underscores the potential impact of well-thought-out financial policies. One of the biggest crimes that people talk about, not real criminal penalty crimes, but ways we let down younger generations, is not teaching them about financial literacy. This is where you can have big benefits, not just to those individuals, but to the economy as a whole. So Sweden's example offers really a critical lesson for European countries, maybe even the US. And as we continue to see shifts in global financial trends and inequality, the Swedish model stands out as a blueprint for fostering a dynamic and broader market. I'm Luke Guerrero, and this completes another episode of InvestTalk. We thank you for listening, and we encourage you to go and download our podcasts anytime for free on iTunes, Google Play, and Spotify. And please be sure to rate and review us on iTunes. Remember to tell your friends that the InvestTalk podcast is now available in video on our YouTube channel. Just search InvestTalk, and don't forget, that's 2 T's. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, and your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.